Let's now bring on board Sunil Subramaniam, the MD and CEO of Sundaram Mutual Fund. Mr. Subramaniam, good morning. Thanks so much for joining us today on ET Now. Yet another day of gains for the Nifty. This time around, it's the banking stocks that are contributing. So there's all the more convincing rally that's being put in place right now. What do you think is lending the market the kind of strength that we are seeing? Because globally you're not seeing this kind of strength, and India is the stark outperformer. In fact, it's this outperformance that has made us the 7th largest stock market from a market capitalization point of view. So where are we deriving our strength from, really?
I think we are deriving our strength from the fact that we are probably the country which has shown the greatest improvement in the vaccinations. I think in terms of second wave controlling and muting a third wave, the pace of vaccination and the zero prevalence. I think that's a stark difference because the Western world is experiencing the impact of the Delta, but we are not. That's number one. Number two is the fact that the world markets may not be reacting as well, but the world growth story is continuing to have a strong underpinning, and India has shown its strength in grabbing the export pie. So exports has been the surprise winner for India, which has calmed down the foreign investors' worries about whether a rise in commodity prices from a world recovering would hurt the Indian economy. But I think exports has come in and shown that we can grab the momentum of growth in the world through gaining a share from the China Plus One strategy, which the government has successfully started implementing through its PLI scheme. So I think that's the second. The third thing which comes from this is this export momentum and the PLI momentum means that domestically, right, there is going to be capex from the private sector. The government, as you can see, their revenues have been cooked and they're also not letting up on spending. So as a result of this, the government capex plus private sector announcements on capex gives a strong bullish undertone to all the suppliers to capital goods. So I think that's a great thing. And fourth and finally, the fact that these export-oriented industries may not necessarily be listed in a stock market, but what's going to benefit is the services sector, which is going to benefit from this export push and from the capex push. So I think there's a lot of reasons for foreign investors to invest in India, and at the same time, domestic investors, because interest rates are so low, so alternatives to the equity markets are far becoming less attractive. And so the flow into equity markets with SIPs running into almost 10,000 crores and the demat accounts sharp rise showing that retail investors are now directly participating in equities gives an underlying strength. So I think all of these factors put together is what has given us this bullish undertone to the India story.
Could valuations quell this party that we are seeing, this bull run? Because obviously the PE that we are trading at right now is extremely high. At the same time, of course, India Inc. has managed to clean up its balance sheets as well very well. So that could be an added measure, I'm sure, in the reasons why the market is rallying. But could valuations quell this party or moderate the momentum?
I don't think so, because I think the market is moving to a new dynamic. So what is that? The first is that don't look at trailing PE. Look at forward P, but don't look at forward P for the current year. Look at it for the next year. So 22, 23. So that's number one. Second is that given the sharp fall last year in our GDP and the sharp bounce back, right, it's more important to look at a valuation story like a PE growth, the PEG ratio, which when you then plug in the expected growth of high single digit for the following year, I think the valuations look reasonable. The third aspect is, if you notice, a lot of IPOs coming into the market are from new sectors where historic valuation models don't apply. I don't need to take the names, but all the kind of new age businesses can't come on the old PE ratio valuation model. They are more in terms of the phenomenal exponential growth. So I think the market is discovering new valuation dynamics, and that's where the story lies. So I think last and finally, the existing earnings expectations of analysts has all been beaten by the companies. So clearly, analysts are lagging in terms of projecting the future earnings growth, and that positive thing has given a further impetus to the fact that don't look at current valuations in terms of trailing, but put your eyes forward in terms of the new dynamic.
Right. Sunil, hi, good morning. Just looking at the return of the laggards, and let's start off with the top name, ITC. I was just discussing with an earlier guest as well as to how, while Sanjeev Puri made it very clear as to that the market was not looking at ITC as a conglomerate, but just as an ESG sensitive cigarette company, and not really recognizing its fair value. And at the same time, he also said that, ITC is a lot more than the cigarette business. It's FMCG as well as hotels as well. Why do you think all of a sudden markets has recognized the true potential of ITC?
I can't talk stock specific, but this story about ITC is also similar to the story on PSU banks. So what has happened is that the flood of liquidity led to the market focusing on growth at any cost. They were just buying growth. And soon there became such a disparity between typical value-oriented companies and the growth that it looked like the value made immense sense. And I think then companies like ITC, PSU banks, all of these are benefiting from the fact that they lost liquidity so much in the initial rally that the relative difference now makes them very good value picks. So I think the market is now coming back to what we've been always saying, to buy growth at reasonable prices, not growth at any cost. So that's what has changed in the market dynamics. The market is now looking at, is the price at what I'm paying worth it? And that's where all of these stocks that you mentioned and what I mentioned come into play. I think there is this recognition, and you will see the value pack has now started to catch up with the pure growth pack, and all of these stocks that you mentioned are benefiting from that kind of a change in thought process.
Sure. The other big development also is the formation of NARCL, which was announced by the finance minister just yesterday. The fact that the formation of a bad bank is going to help improve the balance sheet of banks. Just wanted to understand from your perspective, Sunil, as to how much do you think this is going to really help, given the upfront cash payment also, which it has been enabled for, aid in providing incremental cash flows, enable banks perhaps to focus more on core operations, etc.?
So there's a larger story here, and I'd like to take some time to spend on that. So what has happened is that ever since the pandemic started, right, the bank stocks have been hammered in a way relative to the rest of the market because of fear of the COVID in terms of what's going to happen to their portfolio. But all the banks, right, bar none, have been excess providing for these anticipated bad loans. And as you're now discovering, those provisions were far in excess, right? Number one. At that time, the beginning of the pandemic, there was no thought of a bad bank. So without taking that into consideration, these banks created COVID-specific provisions. And you also see that the collection efficiency of all the top banks are in the high 90s, 95 plus. So that factor that the bad news is not as bad meant that they're all sitting on excess provisions. Now comes the news of a bad bank. What is a bad bank going to do? It's going to take those toxic assets and park them. Now there's a cost to the toxic assets, but the key point is banks have provided for the toxic assets. So the fear, originally the idea of a bad bank was that the bank's financials would get affected by this toxicity and hence they have to bail out. But the situation is the opposite. So having now excess provided, when these toxic assets move to the bad bank, not only will they get the cash from the bad bank, but they'll get cash far in excess of what the written down value of these toxic assets is on their balance sheet. So A, it's cash positive. Second, it frees up management time on following up these toxic assets for recovery and all of that. The bad bank will take care. So lending resources of people will now get freed up to go and get fresh business. So overall, this is the underlying tone that the bad bank clearly demarcates. It's like a segregated portfolio, right? Where that's passed on to a new entity. There is a cost, no doubt, but the good point is the cost has already been absorbed and factored in by the recipient banks. So all in all, this is a good story, not just for the current in terms of the cash positivity, but also in terms of future, in terms of management resources not being diverted to managing bad portfolio, but they can focus on growing that business. And I think that's the way the markets are also going to read it, and we continue to retain our bullish stance on the banking space.
Okay. Sunil, since we are speaking on banks and you have a bullish stance on banks, you mentioned a variety of factors. But, within the entire space, you have private, you have public sector banks, which have also started showing some amount of gains in these recent days. You have NBFCs, and the entire financial institution space. So how would you, within your pick, how would you pick and choose? And would you also look at the corporate facing banks more versus the retail ones? Because we understand that some banks have been saying that we are seeing a few retail delinquencies. So if you could talk to us about what would you look at when picking banks?
So I think that if you look at it, there's the governance, there's capitalization, and there is quality in terms of the portfolio book, right? So on terms of governance, obviously we would prefer the well-owned banks, widely dispersed banks, one. Second, in terms of the corporate governance, I think the past track record is very critical in terms of how they have quarter on quarter talked about their provisions, talked about the future and how that has actually turned out. So that's the quality of corporate governance. The third aspect here is the quality of the book. Now, the quality of the book is both on the borrowing side and the lending side. On the borrowing side, the reason you mentioned PSU banks is because they have a very good CASA and a widespread network of sourcing retail deposits. So that gives us strength, and they're not dependent only on a few large ticket corporates to take. So that gives us strength. But on the lending side is where the question that you rose about corporate versus retail. Now, all these days, the focus has been on retail because everybody felt that spreading your risk over a large number of loans was better. But as the pandemic is coming into play, right, we will see that the small retail tickets are the ones which are facing pressure. But if you look at what I was speaking earlier in terms of the export push that's happening, in terms of the capex, that's the PLI scheme, it is clear that the future is in corporate. So clearly what you pointed out is right, that there is going to be a tilt in terms of the way we look to say that corporate portfolio, especially the bad bank also come into picture, because the bad bank is going to take care of the toxic corporate book. So banks sitting on a lot of liquidity, sitting on fairly low cost of funding, are now going to look at financing the broad range of large, mid and small companies in terms of the capex. And if you know that mid and small companies are still paying double-digit interest rates in terms of the loans. So the NIMs, the net interest margins on these fresh loans are going to look very, very attractive. So a bank which has got well provisioned for its older corporate bad book, as they call it, and not overly exposed to retail, and hence the concern around how the delinquencies are going to be, would be the right kind of a pick. And I think a healthy corporate book going forward, right, will be the key, return driver for banks in our perspective. And that's where, when you talk about PSU banks, their strength has also been largely on the corporate. And that's one of the reasons that a value-based buying on the PSU banks has picked up, because they are at much lower price to book. They have a much better CASA and retail borrowing book. At the same time, they are more corporate oriented in terms of the lending, and I think they will cater to the revival in the Indian economy in a much better way. So I think that if you look at it, then to put it down in perspective, I would still put 50 to 60% of portfolio in good quality private banks and about 20 to 30% in the good quality PSU banks, and the rest for the top quality NBFCs.
Sunil, in one of your initial answers, you spoke about that liquidity gush and the whole growth at any cost factor that this money was essentially chasing. So that brings me to the topic on IPOs, especially the new age ones, the Zomatos, etc., which have never seen a profit on their bottom line. Now, obviously, spotting this liquidity rush, the companies as well decided might as well cash in really by listing on the secondary market. This is an opportune time as well. And the way all of these IPOs are getting subscribed and oversubscribed is tremendous. Do you see rational in investing in these companies, especially when they really don't meet our general Dalal Street parameters of return ratios, etc.? Yes, growth promise is definitely there, but earnings promise or net income promise is lacking a little bit. Do you think that the Dalal Street's tolerance towards this would improve, or do you think that once the liquidity would pause, this would stop?
No, if you go back and look at it, right, the developed markets have a good answer to this. And if you look at the FANG stocks, you look at the Amazons of the world, right, they also started on very similar premises, right? So what happens here is 2-3 things, right? First of all is that in betting on these things, right, there's a winner takes all approach in the marketplace, right? But who's going to be that winner? It's not clear. But the winner is going to walk away with such a huge share of the profit pool that it will more than make up for any losses that you might make elsewhere, right? So that's number one. Number two is the fact that these companies, when they tackle the capital markets, yes, the initial one is the private equity and the venture capitalists cashing out, but they use this capital in their balance sheet to go and acquire. So what happens is that if you're buying, say, 10 companies, the fact is that 2 survivors, but it's not that the others are going to be just loss making. They're going to get bought in, and there'll be acquisitions, and you'll have a big megalith. Now, again, predicting which is going to be that big winner is tough. So the way to look at this is that, yes, there's limit the component of such IPOs in your portfolio. That's number one, but definitely have a share. Don't go zero on that. One. Second, playing in that space, diversify across as many of these new age players as possible so that you make sure that 1 or 2 winners are there in your portfolio, which will more than compensate for whatever the rest do. I think so, approaching this in that manner, right? Diversification, because at this point of time, expertise on discounted cash flow, projected earnings is not going to help you at all. So the right way to look at it is, there is a new age play. Going by the track record of the Western world, these things could be multi-bagger winners in the future. So play that, but play it with a diversified pick across all of these kinds of plays so that the winner will be in your portfolio ultimately.
Okay. I was just seeing some of the top sectors that Sundaram Mutual Fund, does own across its different funds. And I noticed that IT is actually at the bottom of the pack. Usually we see IT at least being in the top 3. Is this on account of any conscious decision to think that, maybe now IT has run up quite a bit, TCS, Infi, etc., at record high levels, etc., and there could be some cost pressures. Is that one of the reasons why, IT is still at 9% of your overall portfolio, or has this always been the case?
You see, I'll tell you what, we remain bullish on IT, okay? But what we have done is we've shifted focus to much more mid-cap and smaller cap IT because we believe that the valuations are still not caught on to the growth potential. We think IT has gone through a Y2K kind of a reset post the pandemic, and the future is very bright. So if you're seeing any kind of a lower share for IT, it's only because the biggies, right, and the values have gone so much that we have just reallocated to the next gen winners, right, the emerging IT blue chips, right? So that's why we shifted focus. We continue to remain bullish on IT as a pack, no doubt on that. The fact is that the proportion in the portfolio might come down because our other picks, right, in the immediate short run, moving to a more domestic economy sensitive portfolio could mean that they have gone up and our picks have been good, so they have appreciated much more. So fundamentally, we haven't gone and sold any IT stocks. It's just that the appreciation of the rest of the pack has made that the IT percentage is where it is. So I would say that I argue that our IT remains positive outlook, and we are much more broad-based in terms of our IT exposure across large, mid, and small.
Right. Sunil, so great to have you on the show. Good to speak with you as always.